A lot has changed in the data in the last week to support lower interest rates as well as a stronger housing market as we move into 2024. Leading the National Association of Realtors chief economist Lawrence Yun to predict a 15% jump in existing home sales along with lower mortgage rates as we head into 2024. And that's exactly what we're going to talk about in today's video. We're going to talk about what's currently happening in the economy to drive down mortgage rates, in addition to talking about how the Fed might be changing its mindset a little bit, along with how that might affect you as a buyer or seller as we move into the 2024 housing market. I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people like you and ultimately helps me accomplish my goal of helping educate home buyers and sellers. And if you find any value in content like this, do me a favor and hit that subscribe button. So the big news is that inflation was flat in October. Well, CPI numbers are in, and we had misses across the board, with month over month and year over year headline and core inflation coming in lower than expected. Inflation was basically flat in October from the prior month, with core CPI hitting the lowest level in 2 years. The October Consumer Price Index hit 3.2% on an annualized basis, which is 0.1% better than the 3.3% that was expected. And a similar note on core CPI year over year, coming in at 4%, which was better than the 4.1% that was expected. If you look at this chart here, you can see that last October, CPI was sitting at 0.5% month over month. And this October, we had it flat at 0%. And how they calculate these numbers is essentially an aggregate of the last 12 months. So with a 0.5% dropping off and a 0% replacing it, headline CPI essentially dropped by 0.5%, bringing it down to 3.2 versus the 3.7% from last month. But here's the thing, when we look back at that same chart, we can see that November and December of last year had relatively low prints when it comes to month over month inflation. So in order for inflation to continue falling over the next couple of months, we're going to need prints lower than what's actually falling off. But the likelihood is that we stay somewhere in that same range, which in theory would end the year with somewhere between 3 to 3.2% with headline inflation. But if we assume the economy is slowing, which we're actually starting to see from some of the GDP forecasts, there's a really good chance that 3 of the first 4 numbers in 2024 will be replaced with lower month over month numbers, which in theory could bring the headline CPI inflation down to somewhere in the mid 2% range, ultimately getting us closer to that 2% target that the Fed is looking for. Now, I know a lot of people are watching this video going, Jeb, inflation is still out of control. Prices are still really high in everything I'm buying, from groceries to just everyday goods. Well, with that said, something to understand is inflation is price momentum, which is different from actual prices. So just because prices stay high doesn't mean that inflation hasn't come down. The fact that prices aren't continuing to rise at the same rate shows that inflation is starting to moderate. But if you want to see the inflation breakdown for October of 2023, here it is all in one chart. So with that, we can see that inflation has started to cool. But one thing I want to point out, which I've done in numerous videos, is talk about one of the leading indicators for CPI, which makes up nearly 70% of the increase in all items less food and energy, and that's shelter. Shelter is more or less flat from last year, but yet this chart shows that it's still reporting with a 7% increase. But here's the thing, we know that rents are cooling, we know that housing is cooling overall, which means the shelter number is going to continue to come down, and with that, the inflation print is also going to continue to moderate. But here's the thing, inflation isn't the only thing cooling. As we saw, the producer price index, PPI, declined 0.5% from the previous month. Now, this is the biggest monthly decline that we've seen since April of 2020. And way worse than what Wall Street was expecting with a 0.1% increase. In addition to that, we saw core month over month PPI come in flat versus the 0.3% that was forecasted. In addition to those two reports, we actually saw retail sales also fall for the first time in 7 months, coming in at minus 0.1%. Now, you would think from hearing that, that shows that the economy is slowing, and that would have a positive impact on interest rates. Because anytime there's bad news in the economy, it essentially means that the economy is slowing, and in turn, that usually helps mortgage rates. But this retail sales number actually had a little bit of an adverse effect on the bond market. So even though retail sales declined for the first time in 7 months, the number came in a little bit better than expected, as they were expecting a minus 0.3%, and it came in at minus 0.1%. So even though it was a bad number, it wasn't nearly as bad as what they thought. Therefore, it actually caused the 10-year to give up a little bit of the gains that we saw over the last week. But at the end of the day, it does show that the economy is slowing. But with that, we know that retail sales is unlikely to continue dropping as we head into the holiday season. So if consumers go out there and spend a bunch of money during the holiday season, that'll actually show up in those retail sales numbers, showing that the economy might not be as bad as it looks on paper, which in turn could have a negative impact on interest rates. But the adverse is also true. If the retail sales numbers actually disappoint and come in lower than expected, then that likely supports a slowing economy, which in turn would lead to lower mortgage rates. But as we've discussed in other videos, the Fed's not only paying attention to inflation and what's happening in the economy, they're also looking at jobs. And this past week, we saw jobless claims climb to a 3-month high of 231,000 jobs. Now, this is the highest level that we've seen in almost 2 years, essentially showing signs that the labor market is finally starting to cool down. And because of all of this data, interest rate traders have essentially baked no more rate hikes into the cake. If you take a look at this chart here, CME futures are saying that there's a 95% chance that there's no rate hikes in December or January. It's actually showing that the first rate cut may start in May of 2024. But with that, there's actually 28% of traders thinking that it might actually happen sooner, coming 2 months earlier starting in March. And with all this data showing signs that the economy is slowing, we're finally starting to see some Fed members use some common sense, with Fed's Daily saying it makes sense to wait on interest rate policy given all the uncertainty. She actually goes on to say, when we know where we're going and it's important to get there, moving aggressively makes sense. But she also noticed that sometimes a different boldness is required, in turn saying the boldness to wait. And while you have Goldman Sachs and Morgan Stanley diverging on Fed rate cut forecast, you have UBS seeing a raft of Fed rate cuts on the back of a US recession. So at the moment, all signs are pointing to a slowing economy, which has caused mortgage rates to dip to the lowest level we've seen since September, causing US mortgage demand to hit a 5-week high, which is something you need to be careful paying attention to. Because mortgage demand was so low and purchase applications were so low, any small increase could essentially be a weekly high. So don't read that and think that the competition is back, that everyone's going out there to buy a house. The reality is mortgage rates have improved, in turn helping housing affordability a bit, potentially getting some of those buyers off the sidelines as they've seen mortgage rates move lower. But with that, you're likely going to continue to see the housing market do what it's essentially done over the last couple of weeks to months, which is continue to slow down. You're moving into the slowest time of the year, which is a time when there's just less transactions in the market to start with due to seasonality alone. In addition to that, you still have mortgage rates sitting above 7%. On top of a recent report coming out from the National Association of Realtors saying that the typical home buyer needs an income of around $107,000 to be able to purchase a median price home, which in turn has pushed housing affordability to a 39-year low. So the reality is not much is going to change until you see interest rates either improve significantly or you see some sort of drop in home prices. And the second half of that equation isn't likely to happen, as we saw home prices rise in more than 80% of US metros in the third quarter. So right now, the big problem in the housing market is that home prices are rising, mortgage rates are high, and the number of price cuts from sellers is actually less than it was this time last year. So what I want to stress is if you're a home buyer out there in the current housing market, you're not likely to see a big change in housing affordability because it's going to take a while for interest rates to continue to moderate. And because of the lack of supply out there in the housing market, you're likely going to see house prices remain strong in most markets. So instead of watching doom and gloom videos out there, instead focus on what you can control as a home buyer. Work on your credit score, work on your budget, work on your down payment, go through the pre-approval process. That way, when the right house presents itself, you're in a position to move forward. And with that, I don't believe that there's a rush to go out and buy a house, but what I will say is the sooner that you can buy a house and become a homeowner, the sooner that you can actually fix your housing cost. Because the earlier you can fix your housing costs, the better position you'll be in long term.